If you have any questions, please type them in the chat window. They will be answered as time allows or responded to after the webinar via email. We've had a lot of interesting questions that I've actually turned into either a blog or a question and answer Ask Tommy that works out well. If you experience any auto problems, please send us a note in the chat window or call our 800 number, 741-4084, and we will try to correct any problems immediately. Let's look at the last hour we did. Currently, a motor carrier could have 3 jurisdictions they will have to comply with. Federal government, they must register with a DOT number, and they must gain authority to haul certain property, which requires an application also for an MC number and certain financial responsibilities. They also have to deal with the state. This requirement is being replaced by the Uniform Carrier Registration System we'll talk about later, but there are still state requirements for motor carriers who are domiciled in certain states and or have activities between cities or locations within that state. The form the state might require would be a Form E or other financial responsibility requirements. The federal government registration, any owner, any business using a commercial motor vehicle, and the federal definition of a commercial motor vehicle is one with 10,000 GVW or higher. That's not an 18-wheeler, folks, but a unit with 6 wheels. That's the dually. That's the 350 Ford, the 35 Series Chevy. If that vehicle is used by the owner in a business that crosses state lines for both commercial purpose, for any commercial purpose, either hauling their own goods, meaning they're a private carrier, or hauling other goods, meaning they're for hire, they must obtain a DOT number. Currently, the form to obtain a DOT number is a 150 form. They would also be subject to the safety regs and rules, and there'll be information concerning them on the website SAFER, who they are, what they do, and any kind of safety violations and or activities on the roadside that will tell us what they're doing. Again, all this can be found through the SAFER website, which we will go in detail in our fourth of the 4-hour sections. The federal registration, if for hire, hauling other property, the property being hauled is processed. Raw agriculture goods are not required to have currently a MC number. Processed goods, raw made into consumer's good, it is required. The example I've always used is my father, who hauled cucumbers, which would not have required him to have an MC number. But when that cucumber got processed into a pickle, then it was processed, and he would have to have an MC number. To obtain it, you would have to obtain an MC number in addition to the DOT number, and would also have to meet certain financial responsibility requirements. The filings in 91X, which is not insurance, is there to protect the public. And it will be, if no coverage in a policy, the insurance carrier who makes the 91X filing would have to protect the public from any damage claims caused by any unit the motor carrier uses as part of their business as a motor carrier using this federal granted authority. The 91X is a certificate insurance. Again, a certificate insurance. It's not insurance. Very similar to all the certificates we send out to our insurance customers today. The only thing is this is sent to the federal government through the federal government website, now done most of the time, or all the time, electronically to a location in Cambridge, Massachusetts. And the 91X is required for anybody with an MC number to complete that process. The only time the certificate is looked at is when an accident happens and no one steps up to pay. We'll talk more about that later. But first, the certificate must be sent in the name the motor carrier is known by the federal government. This, again, can be accessed through the federal website, License and Insurance, which is a link from the SAFER website already noted. This is to complete the process of being legal. In other words, a for-hire motor carrier would have to have a DOT number and also would have to obtain an MC number, hauling processed goods, and to complete the MC number, they would have to make this insurance or this filing by their insurance carrier. The insured in the policy issued to the motor carrier is the owner of the assets exposed to loss. not necessarily the name the government knows them by. So let's don't confuse those two processes. One, policy is to protect the insured's assets. Two, the 91X is to complete the process of the motor carrier being legal at the federal government. The name the certificate's in must be the name the motor carrier has told the government they're operating in, and that would be, again, the information and license and insurance. Whereas the name insured on the policy is an entity that has the assets. Typically, it's the one that has the federal tax ID number. The limits of the 91X have to meet the limits required by the government to be legal. This, again, is found in license insurance. It's not always and not necessarily the limits on the policy. Again, two purposes. The limits of the 91X is to make the insured legal. The limit on the policy is protect the insured's assets. We do not want to promise to protect the public for any more liability than is necessary to make the motor carrier legal. So those two things are sometimes confused. The policy the certificate is based on must also have an endorsement attached to it, and that endorsement is the MCS 90. It's attached to the policy. It's not sent anywhere. However, when you make a 91X filing, you promise the federal government that the MCS 90 is attached to the policy. It's beneficial for a motor carrier to attach an MCS 90 to the policy because MCS 90 does have some provisions in it that will allow some reimbursement in case there's no coverage. We'll get into that later. And again, except for maybe April 15th, it's not good to lie to the government. And since the 91X says it's there, my suggestion is to put it there. So anytime you issue a policy to a motor carrier with MC number, you must also, per the government requirement, attach an MCS 90 to that policy. The MCS 90, in fact, is the document that's going to lead us to how to handle a claim in case of no coverage in the policy. The 91X is not really looked at. The MCS 90 gives us the guidelines of how to handle the claim. Of course, later we'll get into that. The 91X protects the public whether the unit being operated under the Motor Carrier Authority is specified in the policy or not. It's kind of ironical that the federal government adopts words that just the opposite of what we have in the policy if you write a policy where the coverage is based on specified autos. The 91X, as well as later the MCS 90, says even if the vehicle is not specified in the policy, the insured or must protect the public from the insured using any vehicle within their granted authority. The quirk about this is that the authority was to haul processed goods. So any activities involving hauling exempt goods, goods that are not required to have a 91X involved in it. In other words, when my father was hauling cucumbers, the 91X would not protect the public from him hauling cucumbers, only when he was hauling pickles. So this is a quirk part of this. Later we'll tell you where the MCS 90 overrides this distinction. These certificate insurances are continuous. Proof of financial responsibility to protect the public until canceled, either by the insurance company or replaced with another 91X in the same name and limit as the one that has been filed by a previous company. Let's talk about this for a minute, because what we're talking about is that typically we issue an insurance policy on behalf of the insured with a term of 1 year. That period of time is where there is coverage in the policy. The 91X does not have an expiration date. So at the end of the policy term, the insurance carriers have to make a decision either to cancel the 91X to concur with the cancellation of the expiration of the policy itself or not to. The requirement for the insurance carrier to cancel it requires a 30-day notice plus mailing. Now, with everything done electronically, technically it would be a 31-day notice because you don't need to do the mailing aspect of it now that it's been done electronically. Let's talk about this for a second. If you have had the insured for a year and your intentions are to renew that risk, then we come to the end of that renewal process, or the expiration of the policy, and we're now looking at the renewal process. The question that I would ask in most cases is, if we've had the policy for a year, they have paid the insured has paid the premium for a year, and we intend to renew. Now the only thing that we have in place, meaning the current insurance carrier and their agent has in place, is that they have the ability to operate because we've had the 91X filing. And here is the dilemma. Do we cancel the 91X filing if we do not receive a renewal order 30 plus days prior to the renewal of the expiration of the policy? Well, we all know that that would be rare that we would ever get that commitment. Most people wait until the last minute, or at least until the last couple of weeks, before they commit to continue coverage with any particular insurance carrier. But let's say now you also, at what I consider the most critical time involving an insurance policy, and that's the renewal. We have had the risk now for a year. It might have, in some cases, taken us half of that time just to get the policy properly done with the right serial numbers and the right certificate assurances and those things sent out. Again, the thing that where the current carrier and the current agent and the current company is different from anybody else is they have the ability, they have filed a certificate of insurance that gives the insured the ability to continue to operate. If the 91X is canceled prior to the renewal expiration date of the current policy, the federal government will send the insured a note that says you no longer are authorized to do business. That can be overdone with a new filing, but if that's not completed in a proper period of time, then there will be a reinstatement fee. Typically, an insurer does not read anything other than they know that they don't have authority to operate unless they get another insurance policy in place. Here's what would happen, though. Let's say that your insurer did not cancel the filing at the renewal date, or at least 32 days ahead, and the insured chooses not to renew the policy with you and renews it with another insurance carrier. And 5 days after the expiration of the existing policy, with the 91X still potentially in place, there is an accident. The question that then we deal with is who responds to the accident. And this is confirmed, or this verifies what the 91X for. The carrier that would have to respond to the accident, if the accident was caused by a covered auto within that new carrier's policy, would be the new carrier, not the old carrier with a 91X filing. And later, when we have a court ruling, we'll show you the 91X filing would not even come in play, providing the new carrier pays the limits of their policy, which would be at least the $750,000 or $1 million, whatever would require. So their exposure is, if the insured does not renew a policy with you and does not purchase a policy somewhere else covering their operation, that's an exposure a carrier would have if a 91X was not canceled on a timely basis. However, that would be, in my opinion, rare if we intend to renew that risk. So the choice that that the insurance carriers that you deal with have is, do they cancel the policy at the 91X prior to the expiration or at the same time as the expiration of the current policy, or do they make a business decision not to? My recommendation has always been for retail agents to check this position with the insurance carrier so that they can alert to their insureds on how those are going to be handled. Again, this is not insurance. This is there to keep the insured legal. That qualified us at the federal level, but our insureds deal with the states. The states are where the insured either domiciles or operate in. If the insured only operates within one state, that's called an intrastate motor carrier. That's operating only within one state. And some states have requirements to operate within that state. They will require a proof of financial responsibility to obtain the license plate, or some states have authority to operate within the points in that state. Clearly, if your insured is domiciled in that state, purchase a license plate in that state, or has points of operation within that state, they must meet those state insurance requirements. The forms that the state requires in all states but California is a Form E. California is the DMV 65. That's the California Unique Certificate Insurance. It looks like an Accord form, but has basically the same wording in it as the Form E. The certificate insurance is sent to the state to get the motor carrier legal to operate in that state, again, only when the motor carrier is domiciled in that state and operates intra-state in that state or has points of pickup and delivery within that state. It's just like the 91X, a promise to protect the public even when there's no coverage in the policy issued in motor carrier. The limits vary, depends on what state you're in. For example, Texas has $500,000 limit requirement. Florida has a $300,000 limit requirement for vehicles that are over 45,000 GVW. And North Carolina has a $75,000, $750,000 limit requirement. So the Form E does not specify in most cases what the limit is. It's whatever the limit that the state requires. Just like the 91X, these certificates also are continuous until canceled. However, there is a major difference here than the 91X. When the 91X gets replaced by another insurance carrier, the old 91X gets canceled by replacement. When a new 91X is filed, a new Form E is filed, the old Form E doesn't get canceled, it just gets replaced. And if the carrier who made the Form E cancels theirs, the old Form E then raises back to the surface. So it's far more critical to cancel the Form E's if the policy was not renewed, because there's no automatic cancellation like in 91X when the 91X gets replaced by another carrier in the same name and limit as the current carrier. When you file a Form E or the California form, then you add an endorsement to the policy that's a Form F showing what state the Form E was issued in. Or if in California they require an endorsement to the policy, which is DMV 63, which is California Unique. This endorsement basically says, again, this process is to protect the public. It has no coverage provided in it because the forms say if payment is made when no coverage is coverage in the insurance carrier, when no coverage, the insurance carrier can seek reimbursement from the insured. So again, the only purpose of the Form E or the California forms is to protect the public. There is no coverage provided to the insured in this process. That's to keep them legal in the states. However, there is a major change in this part of it, because the federal motor carrier if the federal motor carrier is not domiciled in the state, does not have operations picking up point in the state, they no longer have to deal with the state. They only deal now with the federal government to register as an interstate motor carrier. This step will allow the motor carrier to haul all cargo and to operate in and through all states. This was a part of the Safety Lube Transportation Funding Bill of 2005. The uniform carrier preempts state law that requires separate state registration of the interstate truck motor carriers. In fact, to quote the law itself, it says, "It shall be considered an unreasonable burden upon interstate commerce for any state or public subdivision to require any interstate motor carrier or motor private carrier that also performs intrastate operation to pay any fees or taxes which a carrier engaged exclusively in interstate operation is exempt." In other words, the states do not have a right to, per federal law, to require a for-hire motor carrier passing through that state to register with the state, provide any financial responsibility, or pay a fee to that state. So a motor carrier who might have to meet the state requirements, again, would be the ones who only operate within that state. They need to then meet whatever the state requirements. They're not registered at a federal level. They do not have federal financial responsibility. They are a true intrastate trucker, never crossing state lines. An interstate trucker might have to meet federal financial responsibility in that state. They're domiciled in for any intra-operation within the state. There's no requirement to meet the state financial requirements or restructure in states that are not domiciled in once the Uniform Carrier Registration System are met. This is really the biggest difference in the past history of the financial responsibility. When I first started this process some 30 years ago, a motor carrier would have to have a Form E in all states that they would go through. That was replaced by the single state registration system, which was also then replaced, by that was called the bingo stamp, that was replaced by the Uniform Carrier Registration System, that now is replaced by this new Uniform Carrier Registration System. So now we deal with far fewer states from the point of Form E's than we did before. Again, the key to that is your motor carrier domiciled in that state? Then they would have to meet whatever requirement it is to purchase a license plate and or to operate between points in that state. But if they're not domiciled in that state or do not have operations in that state where they pick up and deliver between points in that state, they no longer have to register with that state. So let's summarize. When a motor carrier asks the insurance industry, their retail agent, to get them legal, what they're asking for is to meet the government-imposed financial responsibility requirement. At the federal level, interstate for-hire hauling processed goods commodity. Later we'll see in the Uniform Carrier Registration, all for-hire and some private, they will have an MC number. This requires a certificate of insurance of liability that has a minimum of $750, for a lower hazard, $1 million, or for extra hazardous, $5 million. There's also a requirement for a cargo, but now only for household goods. This was replaced by March the 21st, 2011. All cargo filings were canceled. If you haven't seen the question and answer that I had posted because of the question from one of y'all a couple of weeks ago, where this agent had an insured who was applying for freight forwarding authority, and they got a letter from the federal government that said that cargo filing was required. They called me up and asked me, they said, Tommy, you said it wasn't required, but yet the government is sending a note to our insured that says cargo filings would be required for this freight forward. Again, not a household goods carrier, but just a property hauler. And I said, well, I'm right. Let me go on the federal website. So I went on the federal website. Between SAFER, you can go into the FMCSA homepage and go to the federal regulations, and lo and behold, the current published requirements for financial responsibility of a motor carrier still shows cargo filings. What I had to do is go back to the Federal Registry back in March 2011, in fact 2 years prior to that, which sets the law that was effective March 21st, 2011, that says all cargo policies were voided. Point made here is even the information in the federal webpage is wrong concerning the cargo filing currently. And I don't know what else is wrong there, but that's the only thing we looked at. No one needs a cargo filing anymore except for household good carriers, and they would need a $25,000 cargo policy. State requirements. Interstate registered motor carrier. There's no requirement from states passing through to meet any state financial responsibility requirement. For hire, all and some private. Uniform carrier registration. No proof of financial responsibility by state if registered federal interstate motor carrier. However, intrastate operation, ones where they don't leave the state, if not a federal interstate, then they must meet those state requirements. And those state requirements would depend on what the state authority is: the Public Service Commission, the Public Utility Commission, the Public Service Commission, the DOT, California Department of Motor Vehicles. In those states, to meet the requirement, it would be, again, a Form E for the liability. Interstate requirements might still need to meet the state requirements in states they are domiciled in or transport property between points. There's also a requirement, like in Florida, for the purchasing of a license plate. These are pre-operation requirements. Must be made, or the motor carrier is stopped by the state, fined, and a lot of times their business is interrupted. However, this is not insurance. This is only financial responsibility to operate legally. It's only there to protect the public. The financial responsibility provided only affects claims when there is no coverage in the policy provided by the insurance carrier. So the process is an accident happens, a claim comes in. The first discussion is you don't look at these Form E's or 91X's, you look at the policy. If the policy has coverage in it, if the vehicle that caused the accident is a covered auto within the terms of that policy, then the policy responds and takes care of the damage done to the public from these accidents. However, if there's no coverage in the policy, the insurance carriers who made these filings could still have some liability and would still have to respond to the need to protect the public in the states. And therefore, these Form E's and 91X is a fail-safe solely to protect the public, not to protect the insured. It's not insurance, it's protection of the public. There is also one other requirement, and that is to affect all users of commercial motor vehicles 10,000 GVW or larger, both motor carriers and other users of commercial motor vehicles. Again, plumbers, lawn maintenance companies, anyone who uses a vehicle with 6 tires or larger would have to conform to this other requirement. This other requirement is to have an MCS 90 attached to the policy. The Motor Carriers Act of 1980 sets these requirements in for the required to be on the policy issued to the insured if that insured is a for-hire motor carrier hauling in interstate commerce. The 91X states the MCS 90 is on the policy. Those are only for carriers motor carriers who currently haul processed goods of others. That is not a requirement for exempt haulers currently. However, an exempt hauler would also have to have an MCS 90 attached to their policy. It also states that private carriers hauling hazardous material, hazardous substance, or hazardous waste in intrastate commerce in any quantity would have to have an MCS 90 on the policy. If they never leave the state, then they would have to have an MCS 90 attached to the policy if they're hauling in bulk. For most commodities, bulk is defined by the federal government as 10,000 pounds of a liquid or 1,000 pounds of a solid. This again affects all units 10,000 GVW or larger, interstate or intrastate commerce, depending on the definition. The MCS 90 is an endorsement to the policy issued to the motor carrier. It's not sent anywhere. The 91X states the 91X states it's on the policy. So when you issue a 91X, you then must attach a MCS 90 to the policy. This only affects motor carriers with MC numbers. Somewhere around 160,000 today have to have an MC number and would require you to have the 91X. Other people also need an MCS 90 attached to their policy beyond this. Again, an exempt hauler, if they're for hire, and certain private carriers, depending on if they're hauling any commodities, interstate commerce or not. In the latter case, my suggestion is, both as a retail agent and the company, is that you don't attach MCS 90 to the policy unless the insured asks you to. This is an obligation by the insured, our obligation of the insured by the federal government, not an obligation of the insurer or unless asked to attach the MCS 90 to the policy. Clearly, if you make a 91X filing, then you would have to do it because you told the government it's there. But all others, you would not want to do it until the insured asks you to do it. Currently, the only verification that the MCS 90 is attached to the policy is when a DOT officer does a compliance review at the insurer's location. In other words, they knock on the door and say, I'm here to help you. And then at that point, one of the things they look at is their insurance. And when they look at their insurance, they'll see if there's an MCS 90 attached to the policy and if they have a proper limits to meet the requirements of the Motor Carriers Act of 1980. If they're not, then there could be some fines and penalties that we'll talk about later. The MCS 90 modifies the terms, conditions, and responsibility of the policy. Again, it's like any other endorsement that's added to the policy. It modifies the policy. The MCS 90, unlike the 91X, does expire. It expires when the policy expires, like all endorsements to the policy. The name and limit must be the name the DOT knows the motor carrier by, and the limit required by the DOT in, again, licensing and insurance, not the limit of the policy. So those are the peculiarities of the MCS 90. The MCS 90 was generated by the law called the Motor Carriers Act of 1980. This is the major change in regulation by the federal government. This is a landmark change. This is when the industry went through a drastic change. This is where the authority to operate was no longer exclusive. In our prior webinars, when we talked about registering, we talked about anyone who had authority prior to 1980. That gained that authority was costly. It required proof that there was no other ability, no other motor carrier ability to meet the needs of the customer. It was only there to guarantee the consumer goods could be hauled, would be delivered on an orderly, predictable manner. And there was very limited numbers of people that had authority to operate. They were limited at that time when the Act went in place, somewhere around 17,000 people that had authority to operate in interstate commerce hauling processed goods. And the authority was very specific. It only allowed you to haul the items that you are applied for and over the routes you applied for. For example, when my father was hauling pickles, he applied for authority to haul food goods. And he hauled food goods, again, on routes from the northeast to the southeast. If he wanted to haul other than food goods, he could not do those if they were regulated commodities without borrowing some other person's authority. This is where the concept of trip leases came in place, where my father agreed with another carrier to use their authority for that limited one trip, the term trip lease. And if, in fact, they also were going over a territory beyond where my father could haul. In other words, if they were going from the northeast to beyond the Mississippi River, he would have to have an agreement with another carrier to interline with them to provide transportation for that regulated commodities beyond the territory he was authorized to operate. And sometimes there was a need to, instead of unloading the trailer, there would need to swap trailers. And this is where trailer interchange concept came in place, so that each party could define in their written contract who's responsible for the trailers when the other party was using it. So the term trip leases, the term interline agreement, and the term trailer interchange all came from the motor carriers industry prior to the Motor Carriers Act of 1980. That act also increased the limits from 300,000 to 750 or more. There was a couple years where it went from 300,000 to 500,000, 750. And the 91X, the 91 went to 91X. Now, a lot of people knew where that X was, and this was a trivia question that I have been asking people later, and so far nobody knows. This came in place in 1980 because at that point in time, some insurance carriers did not have the ability to make a filing at the higher limits. They did not have reinsurance in place, and or they were not financially capable of doing that. So the X came in place so that the coverage could be layered. In other words, one carrier would make the basic filings of 300,000, and then another carrier would make a filing of 450X of 300 to meet the final 750,000. Today, most insurance carriers we deal with have a limit of no more, or have capacity to file limits of 750 or a million. The only time that I see today where the layering is involved, where you have a carrier who's writing a basic layer, then someone else writes excess to meet the full requirement, is in the hazardous area, where the limit there is 500,000, or 5 million, and there's carriers who need to have it layered. The only reason I point this out is some of you might have read, and again we'll write a blog about it, where there's proposal in Congress to increase the limits. One proposal was for 4.4 million, saying that that's the inflation rate based on the 750 since 1980. That limit is not going anywhere, and as recently as last week I was talking to a lawyer who is tuned into this, and he says that that proposal has been squashed or at least put aside. However, there is mandated a study by the FMCSA to increase the limit, and that proposal in all likelihood will require higher limits in the foreseeable future. What's the foreseeable future? Probably the next couple of years, and it looks like now that limit will be going from 750 to $1.5 million, $1 million to $2 million, and then the excess layer, meaning for the higher limit for hazmat or people haulers that are now at 5 million is what's up in the discussion. Does that go to 10 or somewhere less than that? But again, the 91X feature where the limits get increased, some of our carriers immediately when the limit is required might not have the reinsurance in place to file the higher limits. So therefore you would have a basic limit and an excess, again using the 91X. The Motor Carriers Act of 1980 also then requires the endorsement, the MCS 90, or summer to protect the public. This endorsement is what also included the environmental restoration. Here's wording out of the Act itself, Part 387, minimum. Motor carrier means for-hire motor carrier or private motor carrier. The term includes, but is not limited to, a motor carrier agent, officer, or representative, an employee responsible for hiring, supervising, training, assigning, or dispatching a driver, or employee concerning with the installation, inspection, and or maintenance of a motor vehicle and or accessory. So the term motor carrier under the limits of the Motor Carriers Act of 1980 is both for hire and private, and any employee involved in that operation. So let's look at who has to comply with this minimum financial responsibility requirement. This is found in 387.3. The first part says this subpart applies to for-hire motor carriers operating motor vehicles transporting property in interstate or foreign commerce. Again, the 91X is required for people who are hauling property that is processed. The MCS 90, or the Motor Carriers Act of 1980 requires anybody for hire hauling property in interstate commerce. So where my father would not have to have a 91X if he was hauling cucumbers, he would have to meet the requirements of the Motor Carriers Act of 1980, which would require the MCS 90 endorsement when he was hauling the cucumbers. Second part of this is, it's when the property is interstate commerce, not the vehicle itself. So we have insureds hauling from railroads, from airlines, and or more often from the water and intermodal operations, even though they never leave the state of Texas, California, Florida, Virginia, New Jersey, whatever state they receive those properties in. Since the property came from another state or foreign government, they would still need to meet the requirement here, even though they never leave the state that they pick the property up in. That's provision 1, for-hire carrier. That requires a limit of $750,000, we'll see in a minute. The second part of 387.3 is this subpart applies to motor carrier. Again, here, note, it's not for hire, it's all motor carrier, both private and for hire. Operating motor vehicles, transporting hazardous material, hazardous substance, or hazardous waste in interstate, foreign, or intrastate commerce. That's anybody hauling anything hazardous anywhere. Because unless you're hauling to the moon, there's nowhere else to haul but in these places here. So that is a requirement for the hazardous haulers. There is only 2 exceptions to these requirements, and that is found under C. The rule in this part do not apply to motor vehicles that have a gross vehicle rating of less than 10,000 GVW, meaning that it has 2 wheels, not 3 wheels. This exception does not apply to people that are hauling Class A explosives or hazardous poisonous gas or Class A explosives. So the key part here is the vehicle got 2 wheels or 3 wheels or 6 wheels? Excuse me, 2 axles or 4 wheels or 6 wheels. If it only has 4 wheels, it's not conform. It does not have to comply with this. If it has 6 wheels, it has to. There's been a couple of court rulings that have come down that we'll talk in more detail about in our annual conference that Rob Mosley will share with us, where there was a vehicle that was owned by a motor carrier, less than 10,000 GVW, used by that motor carrier that had an accident, and the court ruled since the vehicle was less than 10,000 GVW, the MCS 90 did not come in play, which is a favorable ruling. So the first benchmark here is, exception is, if the vehicle is less than 10,000 GVW, then this does not comply. If it's over 10,000 GVW, then they must comply to this and have the Motor Carriers Act of 80 met with the endorsement. The second rule is, in my opinion, the dumbest one, and that is depending on if it's in the cross state lines or not. If that's the 2. What it says here is if they're hauling non-bulk, meaning items that are not 1,000 pounds of a solid or 10,000 pounds of a liquid in intrastate commerce, then the rule does not apply. What this says is if you're hauling any quantity of a hazardous good across state lines, then you need to meet this requirement. But if you're only operating intrastate, in other words, you never leave the state, then you do not have to conform to the Motor Carriers Act of 80 unless you're hauling in bulk. If I'm a for-hire carrier, the difference here is if I'm qualifying under A, then I would have to have 750. But if I qualify under as a hazardous commodity, I'd have to have 1 million. And it's any quantity. For example, we had a risk that was talked to me about by one of your agents, and that is a person who was hauling metal shelving. We would all agree that metal shelving is not hazardous. However, they started to include a can of touch-up paint in the cartons of the metal shelving. 1 can of touch-up paint makes it hazardous. As far as the state line goes, here's the problem with this. If you're living in Fort Myers, Florida, this isn't a problem because we are 2 days and 3 lunches away from going across state lines. But if you're in Tallahassee, if you're in Jacksonville, if you're in Charlotte, if you're in Cincinnati, if you're in any of the state, Reno, any of the states that are close to the state lines, where the trade area of your insureds require them to go across state lines. I was in Dubuque, Iowa one time for the agency up there, and actually when we went to supper, we went to 2 other states. I'm going to be in Omaha next week, and for you who have not been there, you go through 2 states from Omaha Airport to downtown Omaha. So in those places, if your insureds are lawn maintenance companies, auto parts stores, contractors, and that lawn maintenance company has a vehicle that has 10,000 GVW, meaning 6 tires, and cross state lines with 1 weed eater, they would have to meet the requirements imposed here. If they never leave cross state lines, they would not. This is will become important later because of the new enforcement of this, but that's the key here, where you are from the state. If you're a for-hire carrier, it's pretty self-evident, and those have been meeting these requirements all the time. But there's a lot of the non-for-hire private carriers, particularly ones who are operating less than 18-wheelers, who have been skirting this requirement for a long time. And yet, just because they have not conformed to it, have not been caught, doesn't mean they're illegal. And here's the difference. Currently, the only proof of this is in the insured's offices. The DOT officer can go in and inspect, and the only place you have to have proof of this is in their office and attached to the policy. And in those cases, if the DOT officer comes visits and there is not attached to the policy, then there can be $11,000 a day fine. The MCIEF 90 itself, and this is the provisions here that we talk about, has a new cancellation provision in it. And this is what I teach when I teach this to people who are not familiar with this. I said this is important because this is dealing with your money. This changes the cancellation provision. It says cancellation of this endorsement, which now is attached to the policy. In most cases, this also requires the cancellation of the policy, may be affected by the company or the insured by giving 35 days notice of this cancellation proof of this. This is the major change. It's a bilateral requirement for either the insured or the insurer to send the other written notice in the cancellation of the endorsement or the policy. So the termination of the policy, this is not non-renewal. When the policy terminates, this terminates. But any pre-policy expiration that needs canceled must have this notice by either party. And really, it's not a 35-day notice, it's a 36-day notice. Some judge somewhere asked an agent, what is the effective time of our policies? As we know, it's 12:01 a.m. So to give a full 36 days, the notice must be, 35 days, the notice must be for 36 days. Even for non-payment, even when the premium finance company is involved, because the only right the premium finance company has is the insured's rights by a power of attorney given to the premium finance company by the insured so that the premium finance company can request the policy to be canceled on behalf of the insured for non-payment. Again, the 36 days. So the bottom line is you need to get 25%, 3 months worth of premium up front in good funds, or you're behind the earned current premium from day one. This leads to direct bill. As you know, in the marketplace today, there are carriers who will do direct bill. I'm not talking about payment plans that are agency bill, but direct bill. This then pushes the burden of this cancellation and earned premium not on the retail agent, but on the insurance companies doing this. There's no difference here between regulated and exempt for hire. There's no difference here. This is anyone with the DOT number would have to pay a fee. The MCIEF 90 here has these following considerations in it, and this is to meet the requirement of the Motor Carriers Act of 1980. The first thing it defines is a new term called public liability. Public liability means liability for bodily injury property and environmental restoration. Environmental restoration is simply pollution cleanup. The important part here is if you write standard ISO policies exclude pollution caused by cargo. Yet when you add an MCIEF 90 endorsement to a policy, you promise to provide payment for public liability, which includes the environmental restoration. So the MCIEF 90 obligates an insurance carrier who places endorsement on the policy to pay any final judgment. There's no defense here, just the final judgment. There's no obligation to do anything until a final judgment is rendered. There has been a recent court case that reminded this where the motor carriers attempted to seek reimbursement prior to the final judgment, and the judge says the form says only for final judgment. It provides protection for public liability, which includes environmental restoration. For motor carriers operation for the maintenance or use of motor vehicles subject to Motor Carriers Act of 80. That's any vehicle 10,000 GVW or larger for hire interstate truckers or motor carriers, or private motor carriers hauling hazardous material for these vehicles 10,000 GVW or larger. Again, just like the 91X, this is not insurance. It does not provide coverage to the insured. It's only to protect the public. Protection of the motor carrier is taken away by also a provision in the MCIEF 90 that says, however, all terms and conditions and limitations of the policy to which this endorsement attached shall remain in full force and effect as binding between the insured and the insurance carrier. So meaning that this provides no coverage to the insured. The limitations, territorial radiuses, driver exclusions, notice of cancellation requirements for the vehicle to be on the policy or not is still in force. And the insured agrees to reimburse the company for any payment made by the insurance company on account of any accident claims or suits involving a breach of the terms of the policy, and for any payment that the company would not have been obligated to make under the provision of the policy except for the agreement containing this endorsement. In other words, this comes in play when there's no coverage of the policy, and if the carrier still has to protect the public even with no carrier coverage, then the carrier seeks reimbursement. This is not insurance. It's a surety situation. It's a performance bond. Like all performance bonds, is when the bonding company has to make a payment, they seek reimbursement. So don't ever call this insurance, and don't ever tell the insured that they have insurance because of MCS 90. So in summarization, the MCS 90 is protection of the public from the insurer's negligence in the use of autos that are not covered by the law. There's a new definition, including environmental restoration, which is pollution cleanup. That definition is included in the definition of public liability. The policy responds to public liability on a blanket basis. The public's protection of bodily property damage and environmental restoration for all autos owned or operated by the insured. However, there is a recovery provision in it. This is where the insured, if the payment has to be made and there's no coverage in the policy, the insurance company can seek reimbursement. So from a coverage standpoint, what we've got to look at is what's a covered auto, and does the policy provide pollution coverage caused by cargo. The insurance carrier or the insured must give the other party also 35 days notice of cancellation. So insurance consideration, make sure all autos owned and used by the insured are covered under the policy. This endorsement attached to any vehicle 10,000 GVW or larger. If you use any auto as a symbol, then there's no problem. The problem is if you specified, which in the trucking arena, the motor carrier arena, you're going to issue if the insured has less than 15 to 20 vehicles. Hired car coverage might provide protection here, but again, depending on the carrier. Watch the insurance carrier's position providing pollution coverage. The standard buyback is CA 9948. A couple carriers have a different wording. You would look at it and determine if those coverages there. Some carriers provide the pollution buyback within the premium. Some ask for additional costs. Some do not offer it at all. What's the reimbursement possibility of being successful? It would be successful maybe as an error of omission concern with the retail agent if the coverage is not offered, to have the buyback or not completely explain the difference between coverage and protection of the public. The various insurance carriers determine if they would seek reimbursement or not. The limits, again, are $750 for hire interstate of any property, $5 million for the extra hazardous, $1 million for the lower hazardous one, and that's for hire in private, interstate or foreign commerce, and the key word here is any quantity. Again, intrastate would be in bulk, and this is 1,000 pounds of a solid for vehicles 10,000 GVW larger. That's the million. So the Motor Carriers Act of 1980 requirements, who must comply? All for-hire motor carriers hauling property when the property is in foreign or interstate commerce. This means almost everyone. All for-hire motor carriers you write coverage for will need the MCS 90. Do you offer or just add to the policy? If you do a 91X filing, you have to add it to the policy. If not, you would offer it when the insured asks for it. There could be others hauling hazardous material, private as well as for hire, all others. What's hazardous? Most anything. Anything that changes the environment. Inter or foreign commerce, any quantity. 1 can of paint, 1 weed eater, 1 lawnmower is with it crosses state lines. If it never crosses state lines, only operating intrastate, then it would be in bulk, and that again is 1,000 pounds of a solid or 3,500 gallons of a liquid. When limits to meet the law, do not put MCS down the policy without proper limits, and all units 10,000 GVW or larger on the policy with the proper limits. If there's no MCS 90 and the insured gets visited, then they could be a possible 10,000 GVW or larger fine. So you have to watch the coverage in the form and promise to pay an MCS 90. That's the symbols and pollutions. So MCS 90 is both required for exempt and non-exempt for-hire motor carriers operating in interstate or foreign commerce. Then 91X filing, made to the FMCSA pledges compliance with the Motor Carriers Act of '80. The insured agrees to pay to protect the public even with no coverage in the policy. There's a reimbursement by the insured for any payment beyond coverage. So the MCS 90 is suretyship, not coverage. It does not apply to the driver. It does not apply to punitive damages. There's no duty in the MCS 90. There could be duties in the policy, but not in MCS, duty to defend, excuse me, in the MCS 90. There might be a duty to defend in the policy, but not MCS 90. There's a claim for reimbursement. That would be the carrier's decision. And the cancellation notice is 36 days. However, there is no stacking of MCS 90. This is the relevant court case that was ruled. That's the Carolina Casualty versus Yates court case that was decided by the 12th District in 2009. Major court case. Basically what the court ruled, and this has been coming the court of the rule of the land, is that once the financial responsibility limit is met by any means, even if the policy did not have an MCS 90 on it, if somebody paid what's required, $750 in the case here, but it would be what's required, then all other federal financial responsibility limits have been made. This is a major court case. Our friend Clay Porter wrote us a letter defining this, and that would be for your reference later to see what the exact ruling is. But this is saying no stacking, and once the payment is made, then all other requirements are met. So when you underwrite a motor carrier who requires a filing of MCS 90, you must address coverage as promised by the financial responsibility. When writing small fleets to be covered auto, it must be scheduled. But the insured uses an unscheduled auto still must have the public protected by the filings or MCS 90. So we, the insurance industry, must insure, underwrite, and collect premium for all units 10,000 GVW or larger used by the insured within the authority granted by the government, that's the 91X wording, or operating, maintenance, or use of the motor vehicle subject to the Motor Carriers Act of 1980. Again, that's the MCS 90 wording. No exception. Policy issuance, you got to verify you have underwritten and priced all units, owned and non-owned. The insured will own, lease, or use during the policy term. Midterm changes. If the insured wants to take a vehicle off and they call you up, you've got to make sure the vehicle is no longer there. It has been sold. When owner-operator leaves, again, you want to see a cancellation of the lease. This is important here to make sure you still don't have an exposure for vehicles that you knew about that wasn't there anymore. At renewal, if there's different types of vehicles there, then you also need to make sure that you have all those vehicles accounted for that were there before. So all government-imposed regulation is to protect the public. This is not insurance, protection of insured. Here's some examples of when the MCS 90 might come in play, or the 91X when there's no coverage. Again, the vehicle not scheduled, it's not newly acquired, it's not a temporary substitute, it's not hired. Breach of the term of the policy, intentional acts, misrepresentation of fraud, driver exclusion, radius exclusions. Again, no coverage in the policy, but the public is protected. Policy expires, and the 91XE is not canceled, and also the environmental protection. Must provide limits to meet the financial responsibility. Limits set by the government, minimum $750 million and $5 million. This is what it depends on what the motor carrier tells the DOT officer. The limit requirement is reflected in license insurance on the federal webpage. You should not, in my opinion, show more limits on the 91X or the MCS 90 than what is required. Why provide coverage where it's not required? Because this only comes in play when there's no coverage in the policy. The insured gets the full benefit of the coverage in the policy. So the only time that this would come in play is when there is no coverage. So why promise more than you have to? I wrote a letter that explains this, that you could download and use to talk to you if your company or wholesaler to your agent, agents to the insured, and insureds to customers. There's another major requirement, and this is the uniform carrier registration. I know I'm a little over here, but I want to get finished here. This was replaced with single state registration, which applied only to people with MC numbers. This is a fee that has to be charged. The fees range from $76 to $73,000. This fee will fee will be paid to the state to enforce all the rules. I point out here the new law, and this is the law that was effective that was just passed last Friday that I wrote a blog about. We're going to do a webinar later concerning this on the 12th, and I just give you a copy of this part of it. So we'll look at that later. The last thing we have here are the need for the tax distribution, and this is the IFTAs and the apportion tags. Again, a requirement to meet information, an information source for us. This, though, is not vehicles 10,000 GVW, but vehicles 26,001 GVW. Again, interstate commerce, private for hire. It's all holders of the DOT number. And this is the two taxing, the IFTAs, International Fuel Tax Agreement. In this case, the mileages that they travel in all states must be reported every quarter. What we want to have a copy of as far as our insurance industry is a copy of this report. It tells us how many miles the operation is. It tells us what states they go through. You also have the license plate purchasing, and this is International Registration Plan. Again, this is what I'm planning to do in the future. This is tied into the license plates. This is a great source of information. When you compare this, though, the concern is how does the insured handle the intrastate miles? IFTA only requires reporting of interstate miles, not intrastate miles. And the insured could have intrastate operations that do local that you have to count for. The Uniform Carrier Registration reflects the intrastate operations. So you also need to consider how the owner-operator, who is permanently leased, does the owner-operator have their own account, or is it their miles reported under the fleet? So when you look at this as a measurement of the insured's operation, you do need to find out about intrastate miles and how owner-operators are taken care of. IFTA, though, is what I have done. IRP is what I intend to do. So sometimes those two things would balance. I feel we need copies of the pro-rata miles that's reported on IFTA and what it's based on. I think you need last year's and maybe the last 2 quarters of this year. This will reflect all how many vehicles insured uses and where they are going. Again, hot subject. This is the UCR completion. The DOT number will be the only identification. The MC number is going away. No motor carrier number anymore, just DOT number. There'll be no more common contract exempt. The new motor carrier will be private and for hire. There's no more cargo filings. And here's the key part of this. By November 2014, anyone who needs MCS 90 will have to have a filing, which will be an exempt hauler as well as a private hazmat hauler. Plus, there's a new application, the MCSA-1, which is a 20-plus application and must be done electronically. We're going to do a webinar on September 12th concerning all these new changes, and I recommend you to doing that. So, when an insured approaches the insurance industry to provide them services, the request is to become legal. This requires a knowledge of the registration requirements. They need to find the registration requirements, the government requirement for tax distribution, provide the information that helps understand the insured, and you need to balance the financial responsibility with the coverage. Our next seminar, our next webinar that'll be done next month will be more information concerning the federal website and how to read those things. We hope you got something out of this. If you have any questions or comments, please refer them to our office. We appreciate your attending this. We hope you got something out of it. And for that, I know I'm a couple minutes over, but we are done. Thank you.